So good evening, everyone. We're just going to wait for around 2 more minutes to let more people to join the webinar. Thank you very much. And so, good evening, everyone. So I'm 𝗍𝘃𝗀𝘀 from 𝗪𝘆𝘀𝗀. So I just want to welcome you to this evening webinar, whereby it's the dynamic investing in a higher for longer regime, United SG Dynamic Income Fund. So in today's webinar, we are honored to have guests from UOB Asset Management to share with us a new fund poised to meet the challenges that the elevated interest rate environment brings. The United SG Dynamic Income Funds aim to provide investors with optimal diversification and income generation amid market volatilities by adopting an AI+Analyst dynamic asset allocation approach. So with me, I have 𝗪𝘆𝘀𝗀, Senior Director of Asia Equities at UOB Asset Management, to provide us with more insights about this new fund. So Paul has over 28 years of investment experience and managed a number of Asian funds at UOBAM. He joined UOBAM in 2008, and currently led UOBAM initiative to apply artificial intelligence or AI in their various investment solutions. So also in this webinar, I'm also honored to have Roger-Ling, Director of Intermediary Sales, UOB Asset Management. So both he and Paul will be happy to answer any questions that you have after their presentation. So if you have any questions along the way, feel free to put them into the Q&A box, and we will get to them over the course of this evening. So without further ado, let me pass over to Roger to start the webinar going. Roger, please.
Hey, hi everyone. Good evening. Thanks 𝗍𝘃𝗀, and thank you for FSMOne for inviting us today. So very pleased to have here with me Paul as well. So before Paul gets into the presentation and all that, I just want to share a little bit with everyone to say that why we went ahead with this United Singapore Dynamic Income Fund itself, which is already available on FSMOne platform. You can actually log on and then you can go through a subscription, which I think 𝗍𝘃𝗀 will go through later on as well. But I think the key point here, or rather two simple points I want to highlight, is that while we know that the T-bills have been very attractive and everybody is very keen on the T-bills and whatnot, but think about it to say that why were you actually going into T-bills in the first place? I think the key point here is that because we were a little bit afraid, we're a little bit more apprehensive and cautious about equity investing because of what has happened in the last 2 years. It has been very chaos. It's been chaotic. There's a lot of volatility and a lot of geopolitical tensions. So hence we decided to take a back seat and went into the T-bills, which is actually it has been a great investment, to be honest. But right now, as we move ahead into the years ahead, right, I think it's time to relook at your portfolio, rethink about having equities in your portfolio. But as you go into the equity part of things, right, we know that it's a little bit more challenging. It's getting a lot more daunting, like I said. So that's where we decided to go going for something that is a more home bias, because the Singapore market, regardless of how boring it is, some of you might think that way, but it's actually very resilient and very stable. And I think that is the reason why we want you to take the progressive step into equity investing again, but looking at something that is home bias, something that something that you're familiar with, and then progress from there into the other markets as well. So I'll pass the limelight to Paul to share a little bit more into what the fund is all about. Paul, please.
Yeah, thanks, Roger. And once again, good evening, everybody. Let me just share my screen very quickly. All right, let me know if you can see it. Okay. So once again, today we're here to talk about this new fund, the United Singapore Dynamic Income Fund. I think a lot of you might have a lot of questions like what Roger said, why Singapore at this moment, and then secondly, why go into this fund, and why AI. I think I'm going to talk about some of these questions in order. Hopefully you'll get some answers, right? Now the first, the case for Singapore. Why invest in Singapore? I think a lot of us, I think most of us should be Singaporeans, right? So we stay in here. We know that the Singapore government is very reliable, is very efficient. And Singapore itself is a very safe place to invest. Okay, and, Singapore has also done pretty well in the last couple of years. And last but not least, Singapore has over the years developed into a very nice REIT market. In fact, it's the largest REIT market in Asia, ex-Japan, right? So all these reasons make Singapore a very attractive investment option. But then I think the question is also why Singapore at this time? I've been in the investment business, like what Roger said, for 28 years. There are I think there's a good times and there are bad times. I always say that there's a season to take risks, and there's a season to be conservative. And I think probably now is not really the time to be taking a lot of risks. I mean, if you've read the headlines, you know what's going on in the world. You know, geopolitical risks, not just in the between China and the US. Now there are all these things happening in the Middle East. And then also, if you look at the US, the largest economy itself, you know, they're settled by debt, huge debt, 33 trillion, and growing by $1 trillion here, $1 trillion there every day. And with interest rates going up, I think a lot of the banking and financial sector is at risk. I think most of you know that. Look at Europe itself. I think the economy isn't doing very well. I think a lot of economies are sliding into, you know, kind of like an economic recession, especially after the Ukrainian war. And then now, of course, China, people are talking about China and how China is weak and slowing down. So, you know, given all these uncertainties, I think it would be fair to say that, you know, there's no better place to put your money than at home. You know, somewhere where, you know very well, you know, things that you can see, touch, and feel, and then you feel you can sleep well at night with, right? And in fact, you know, you look at the Singapore equities, for instance, right? So it's been resilient, it's been stable, and in fact, it's been growing. So if you look at this chart, maybe you can't really see the color very well, but trust me when I tell you that the highest line up there is the Singapore STI investment. In fact, in the last 3 years, the world has gone through quite a lot. So a lot of things has happened, and yet, you know, I think many people will be surprised that the STI in the last couple of years has actually outperformed the S&P 500. Right? How many of you knew that? You know, in the last 3 years, we actually did better than S&P 500. So there you go. So Singapore does, you know, it's pretty resilient, right? Especially when the world is having a lot of trouble. A lot of people feel that they want to go to somewhere safe, where the currency is also very strong, right? But at the same time, it offers slow and steady growth. And then, of course, you know, the STI, like I said, all these companies are companies we're familiar with, right? You know, DBS, OCBC, UOB, Singtel, Venture, Keppel, all these names have been with us for a long, long time, right? Strong track record of steady profits. They pay out attractive dividends. And then also they are household names. Like I said, you know, all of you, if not most of you, would have used, you know, their services at one point or another. You know that they are doing well, right? And you know that they are not at risk of collapsing, or you know, you won't be losing a lot of money investing in some of these companies. So overall, good quality names available at your very own backyard. And how about the Singapore bonds market? So Singapore bonds market, like I said, you know, Singapore government bonds are rated AAA, right? The strongest credit rating that you can give to any country. And over the years, the issuance has become more, which means it's become more and more liquid. There are no capital controls, no hedging restrictions, no withholding tax. So that makes it a very attractive market, also for foreigners to participate and to park their money in, especially, like I said, in times of uncertainty. I don't need to tell you about REITs. I think most of you, if you're active in Singapore, you probably made quite a bit of money in REITs over the last 10 years, right? So the thing about Singapore REITs is the gearing ratio itself is pretty low. In other words, it's quite safe. They are not over leveraged. And then Singapore offers a wide variety of different kind of REITs, right? You want industrial, we have hospitality, we have retail, commercial, healthcare. Like I said, you know, we're quite well diversified. And again, most important of all, they pay, you know, dividends as quite a bit of dividends. You can see the average dividend yield for Sing REITs is now 7.8%, which is very attractive. I think just now Roger mentioned, I think a lot of people are very excited about, you know, the T-bills. I think the last auction is probably 3.85%. But hey, you know, I'm talking here about 7.8%. And you participate in the growth of the whole Singapore economy, right? So in the last couple of years, last 10 years, the average compound annual rate of return for the REITs has been 7%. Again, very, very attractive, right? But, you know, REITs are not the only asset class that is paying attractive dividends, right? If you look at the STI itself, right, the STI, the average yield on that is 4.6%, again, higher than your T-bills. In fact, last week, I think UOB Bank, all right, announced their earnings, and I was just looking through, and maybe you already know this, but I looked at it, and it seems like the analysts are expecting the UOB itself, for instance, right, to be paying between I would say something like 6% dividend yield as well. So again, very, very safe and steady bank paying out a very good dividend. Okay, maybe I'm being biased. Okay, so coming from UOBAM, but I know just an example of what you can get. Again, a very safe investment that pays very good income, right, over the longer term. And of course, another reason why you want to consider Singapore is, as I mentioned before, is less volatile, which means it's less risky than many of the similar asset classes in Asia and around the world. So you can see the vol is significantly lower, right, for the similar asset class. So in summary, Singapore market is a very attractive market to invest in. Again, I don't think I need to tell you that you lived it, you're here. You know that it's safe, and at the same time you get growth, steady growth, and income over the years, right? So then we want to talk about this product specifically and how it addresses what we think are very important client needs at this point. Again, this is a feedback given to us from our clients and what is important to them, and I'd like to share them with you at this point. Now, the first investment need, I think, is quite obvious. The preservation of purchasing power, especially in times of inflation. I think inflation, everybody is talking about the inflation right now. Everything is going up by so much. Gone are the days where inflation is hardly noticeable, right? Nowadays, you look at, house prices, food prices. Now you're talking about COE. Yes, it's come down from 150,000 to 100,000 or something. It's still pretty high, right? So we expect that in the future, inflation is unlikely to go away. It's going to stay high. In fact, the Singapore government says that right now our inflation is probably about 4%. Right? So at the very least, our investment should be able to cover this potential loss of purchasing power from inflation. Now, the second investment need, I think, is the need for income, right, to meet regular expenses. I think this one has been also very well feedback through our clients, also our financial advisors who we work with. They tell us that people want income, and it's understandable. And in fact, Singapore, as I already showed you, is one of the very, very few attractive markets in the world and also in Asia to invest in for income. Right, we talk about REITs, we talk about even the SCI itself giving pretty good yields, and of course, the Singapore Treasury T-bills, bonds also pay out quite good income now, right? So income is, I think, is quite an important aspect. And this one is interesting, right? So we want to preserve our capital as much as possible. I think a lot of you have gone through a very bad year last year, I would think. Last year, you have bonds going down on average about 20%, and then you have equities also going down around the double digit, close to 20%. So if you hold equity and you hold bond, you're like sitting duck. There's nothing else you can do, right? I mean, if you own a balanced fund, if you can only own equities and bonds, both going down, there's nowhere to hide. But did you know? So this is one interesting fact. Do you know that last year, when the both the bonds and global bonds and equities were doing so badly, did you know that even the most risky asset class in Singapore, the Singapore STI, did 8% positive return? Actually, it's 8.28%, right? So 8% total return last year, and the year before that, it did 12%. Well, isn't it wonderful to be able to make a positive return right at your very own backyard when the whole world is actually losing double digits? So anyway, so something to consider. So, it's important to preserve your capital over the long term, obviously. So then this is where the United SG Dynamic Income Fund comes in. right? What are we offering you? So I mentioned, I think the traditional balanced product in Singapore is actually either Singapore equity or Singapore bonds, right? You only have two choices. Unfortunately, if the equity and bonds continue to do badly at the same time, there's nowhere for you to hide. In fact, I think we're seeing something similar this year. In fact, I think going ahead, we might face more and more of a similar situation. And why? Because if you believe that interest rate is going to remain higher for longer, then you will find that both bonds and equities might be under pressure, right? So what happens here is that we've improved the design of this multi-asset product. So versus the traditional bonds and equity only options, now we give you 5 options, right? So you can invest also in Singapore money market fund, or Singapore REITs, and then we just throw in a little bit of Asia equities in there as well. Now, some people ask, yeah, this is a Singapore product. Why do you throw in equities? But of course, we kept it at maximum 20% only. But why put it in? So we've done a lot of number crunching and research, and actually, we found something pretty interesting, right? So if you just stick to Singapore assets alone, yes, it's slow and steady. But actually the returns are actually not that high. So I think from our forecast, we think that actually if you just stick to Singapore assets alone, you might be unable to meet your inflation target, right? To cover your inflation and purchasing power. But the magic happens when you just throw in a little bit of Asia equities, just a little bit, right? It won't bring up the risk by too much, but actually improves the performance profile by quite a lot, right? It's quite significant. So just taking a little bit more risk, we generate a very good return profile. And again, that's kind of like a secret sauce. So there you have 5 asset classes instead of just 2. So we purposely built in the escape valve of Singapore money market fund, right? So that means in situations where we think that bonds and equities are both doing badly, we won't hesitate to park your money in the money market fund, right? And wait for better opportunities. And I think just by this design alone, I think we're very different from all the other, products that were produced in the past. Maybe because in the past they never thought that we could both be negative bonds and equities at the same time. But then now that it's happened, I think it'll be quite foolish for us not to take that into consideration and improve the structure of this product that we offer to you. So this is the the latest product. We want to incorporate the latest safeguards for your funds lah. So that's how we do it. So we the benchmark for this fund is SORA +2. Again, it's very interesting. Why SORA +2? I think the answer is that because like we said, if we just do SORA +2 over the longer period, as you can see from this chart, we should be able to beat the SG inflation rate. So which means we should be able to keep pace with inflation, right? That's what we want. And then say that's one of the aims that we are trying to achieve with this fund. And also, I think I mentioned about the payout. So we regularly pay out, and we aim to pay up to 6%. In payout, right? Now let me talk about the other distinguishing feature about this product, which is the AI, which I personally have developed together with a team of data scientists. Now, how does this work? So I think most of you kind of look back so when you want to make a decision, right? You want to make a decision on when to invest in equities, when to invest in bonds. I think the main difficulty for the man on the street is when to switch, right? And that's a very difficult decision. Now, trust me, like I said, I've been an investment manager for more than 28 years. It's very difficult even for me and for other professionals to do it. Based on the time that we spend, based on the data that we look at. But I think 3 years ago, we developed this very powerful and proven AI system by now. So what we do is we take into account tens of millions of data points. So So imagine this, right? I think you've attended many seminars yourself. Every time you listen, right? So let's say the fund manager says, okay, why do we want to invest in stocks? Normally they say, oh, because, I don't know, because interest rate is low, or because PE is low. And I think they probably can give you, okay, maybe the industrial production is high. So maybe he gives you a handful of reasons. He looks at a handful of factors, literally a handful, maybe 5. I don't know how many managers actually talk about 10 factors, 10 reasons why they invest in an asset class. But and that's normally all they can think about. Then if you are a little bit more sophisticated, what people do is they develop a model, right? So the model probably can take, typically between, they take into account maybe about 100 variables, economic variables like unemployment, interest rate, whatever. So you just throw in 100 of those. But this AI that we've developed, basically we look at 30,000 variables. And we look at the different combinations and permutations, and then look back more than over 20 years of history to see, how these factors interact to give you, their asset class returns. And every time the model makes a decision, it actually considers something like close to 300 million different combinations. So it thinks about 300 million different scenarios before it comes and tell you, okay, this is the best one, right? I don't know how many of you make decisions based on 300 million, options. Considering 300 million options, I certainly don't. And now because we have this powerful machine, we have powerful algorithms now, and we have plenty of data, we can do it, right? In the past, we were only stuck with spreadsheets, but now even spreadsheets are a bit too small for this sort of data. So we developed a model to tell us, in the best possible way, analyze it in the most objective, devoid of emotions, the best option to invest at this point, considering all the data, right? So it's very objective and it's very data driven, right? And then it makes the best decision. And so it helps us to make the correct decision most of the time. And then after that, after it assigns, like for instance, how much to invest in equities, how much to invest in the bonds, how much to invest in REITs, etc. Then we have specialized managers to help to do the security selection, right? So for instance, let's say if it says, okay, I want to invest 50% of the money in Singapore equities, and then we have an equity manager that's very, very experienced. In fact, later I'll talk about it. It's been around for a long time, very, very good track record. Now, these fund managers will then help you to make the best calls on the individual stocks, right? So you win in two ways. One, you generate value by being at the right place at the right time. And then we also have managers to help you to pick the right stocks or the right bonds to make the best returns. So as I mentioned, as a man on the street, I think one of the biggest difficulty is when to buy into this. So I think some people have asked me this question before, right? So Paul, you say I can buy equities myself, right? In fact, you don't even need to buy funds these days. You can. I know this company so well. I can buy these stocks on my own. Then I can also buy bonds on my own. Right now, I can even go to T-bill auctions on my own. Then why invest through a fund? And this is the reason why. Because most people cannot make the correct decision when to go into equities, when to go into bonds. I think what most people do is, as you find out, that most people actually buy very high. So we buy when everybody's buying. So, the stock market is going up. That's why I think finally, after it's gone up a lot, you're very sure already that you put your money and then you invest in your equities. That's probably the wrong time to do it. And then what they do is then after they buy in, the thing starts coming down. And then, at the bottom, they realize, oh no, I think I made a lot of losses. I better get out because there's a lot of bad news, right? Everybody knows about the bad news now, and then they get out. So that is very, very common. And again, I don't blame you for that. It's a very difficult investment. Investment is just very difficult, and making the right call is very difficult. That's why we developed this tool to help us. And like I said, this AI thing is not just developed this year, it's been developed over the last 3 years. And we have other funds that have used this AI, and they have been the best performing funds. So one of them is the United Greater China Fund. You can go and check out the live track record. Basically, I think it's the #1 fund in the market for China. And we've been awarded the Lipper Best Performing Prize for that. So we've been winning quite a lot of awards with this AI. And finally, we decided to use this to help us to make decision on the, what asset classes to invest in. So like I said, these are the 5 building blocks. You can see that our Singapore bonds, our Asia equities, our Singapore equities, they're all 4-star funds rated by Morningstar. And then the Singapore Money Market Fund is also a very, very famous fund in Singapore, one of the best, if not, I think the best money market fund right now available in Singapore, although it's not rated by Morningstar, right? So rest assured, we are combining the best of AI and the best of humans. And that's why I think this is what makes this product actually very unique, right? I think some people also ask me, say, oh, there's so many funds on Singapore right now. What's so special about your fund? And I would say, those lah. So that's what is very special. We run it by AI, and we combine it with our human expertise. And then we have a lot more, choices of asset classes rather than just equities and bonds, which is, I think, very 1960s lah. That's why they developed. That's how they developed in the 1960s. But times have moved on lah. So we've come out with a better product for you guys. Okay, and the other thing we found out about this combination is very interesting. That actually on a backtest basis, the fund is actually is very, very very defensive lah. So one thing about investing I can tell you is that there will always be bad times. Okay, no, you cannot escape those. There will be good times, and then there will be bad times. And the question is, when the bad time comes, how badly hit are you? So you want to lose as little money as possible when bad times hit, and then hopefully on the way up you have more bullets to deploy, right? I think one of the tragedies I think I've learned personally is the tragedy is if the market is so low and so cheap, but you got no money to buy because you already all invested, right? Because you never park your money in the money market fund, and then you went down all the way together with the market. So at the bottom, it's the bottom, but there's nothing you can do. So it's very sad, right? So that's why it's important to make a correct allocation, right? And that's what this fund is trying to do for you. And then you can see here that the maximum drawdown is actually less than 10%, whereas you see the other STI, the maximum drawdown, it's been 30%. REITs, surprisingly, is even worse. I mean, you look at a global equity, some people say, why not invest in global? There you go. Global equities also draw down that much, right? But this one is relatively safer. Again, so we talk about also volatility. Again, you probably cannot see the color, but actually the lowest line, and you focus on the lowest line. The lowest line is the Singapore bonds. So Singapore bond, of course, the volatility is the lowest, is about 5%. And then the dotted line on top is our fund expected fund performance. So we expect it to do a little. The volatility just a little bit more volatile than bonds. But actually the returns is I think we said we're going to do about we're trying to aim to about over the cycle on average about 6 to 7%. So and that's probably what you'll be getting in STI the long term, right? So you can say it's almost like a equity-like return for bond-like volatility. That's what we're expecting this fund to do. All right. So the key takeaway. One is, this fund, we underlying the fund, we have a lot of income paying asset classes. So you got REITs, like I say, even STI pays good income. Even the bonds pay good income. So overall, I think we have a very good base to pay out our income. So again, there'll be good times, there'll be bad times, but we aim to pay out around 5 to 6%. And then there's defensive and resilient. Like I said, Singapore is our own backyard. We've seen how the Singapore market has performed in a very bad market last year, right? So the Singapore market actually made money. So it's a safe, you probably can sleep well at night with. And then the point is also similar, invest in what you know, right? So 80% will be at least 80% will be invested in Singapore. And Singapore is a highly regulated market. The government is highly efficient and very good reputation and stable. So okay, so that's all the points I have. Again, I'll pass it back to Roger. Both of us are happy to take any questions you might have on the fund. Thank you.
Hey, thanks, Paul. Yeah, so maybe we can open up the questions and all that. I think, okay, so maybe let me just give a little bit of insight. I saw a very good question coming in before the FSM team helped to answer with this, is that the current fund right now is actually at an IOP period, which is basically the initial offer period itself. So right now, if you go on to the FSMOne platform itself, right, you can actually input your orders and all, which I think the team will be happy to share in terms of all the steps. What you do is that, because right now the IOP period is actually between 23rd October till 15th November itself, which is next week. On the 16th November itself, that's where the inception will come in, which is the first day of trading. So if you come in right now at this period of time, right, obviously from the 16th November onwards, right, you will start from NAV at $1. Then, like what Paul has shared, that's where we try to see the growth of the fund coming in, and hopefully, we see some appreciation coming in as well. So that's one of I mean, some of the admin part that I want to share a little bit in terms of what is the current status in terms of the IOP period, which is the initial offer period. Maybe I share a little bit in terms of the difference between the three share classes. So right now we have accumulation share class and also the distribution share class. So I think that's quite straightforward for the members of this today who are really invested in the unit trust. You probably will know how's the difference between the accumulation and distribution. Accumulation meaning to say there's all what goes back into the NAV itself. The reinvestment of the dividends collected will actually goes back to the fund. You will see a nice appreciation on the NAV over time as well. The distribution share class will actually start to distribute the dividends on a monthly basis. So I like what Paul has shared. We are aiming about 5 to 6% dividend yield, and actually and payout on a monthly basis itself. So that is where the distribution share class will come in. Yeah, probably I will let Paul help to answer on the return target of 6%.
Yes, sorry, let me see what's the question. Okay, how do you determine the return target? Okay, so we have done the back test. Anyway, this is a long story about how we do the back test. But what we do is we test the model, right, as if and make it run as if the fund is live since 2016, and then see how it actually performs. So the way we perform is we make sure that it does not see any data into the future, right? No cheating. You don't know what's going to happen. We kind of test it as though it's running live. And then over the back test period since 2016, of course, there are some years that are positive, some years that are negative. But on average, let's just say that the returns are more than 6%. Right, so we intend to pay out, maybe 5 to 6% of that. So that's how we determine this 6%, and it's something that we think we can realistically achieve over long periods of time. Yeah.
Hey, thanks, Paul. Maybe I'll just quickly jump into that question in terms of the difference between the B share class and the A. So basically, why the minimum investment amount for B is higher is because that's actually our institutional share class. So basically, it's for our corporate clients, institutional clients, like what Paul shared. So as a fund house, that is backed by UOB Bank itself, right? We've been around since 1986, so over 30 years of experience and all that. We do have a lot of institutional clients that comes in as well. So that's the B share class. The difference is actually for institutional clients. A little bit going back into the A share class, which is the accumulation and distribution, right? One thing to know is that the AMF of the fund, the annual management fee of the fund, is 1%. To be honest, it's actually quite surprisingly low for a multi-asset fund itself. I mean, in the lights of all your equity funds out there in the market, probably you guys are very familiar. It ranges between about 1.25 to 1.75. But for a multi-asset fund itself, at about 1%, it's actually pretty low. I will want to answer that question in terms of is the 5 to 6% target return assuming distribution. So let me be clear. I think Paul mentioned about the benchmark itself. So the benchmark itself is actually SORA plus 2. So we all know that SORA is actually quite synonymous right now in this time whereby we're talking about mortgages and all that. Most of our mortgages are actually tied to SORA. So I think that's also one of the reasons why we wanted to use a SORA plus 2. Because I think what Paul has mentioned in terms of earlier slides when he mentioned about the 3 client needs. So one of them is actually for income. The other one is actually to meet inflation as well. So these are some of the thought process that we went through, and we want the fund that is able to have that kind of benchmark to achieve that kind of return, so that you as a client, right, as an investor, right, you can actually help off to offset your increase in terms of expenses coming from your mortgage, coming from a higher prices in terms of your goods and items and all that. So I think that's the reason why we went with the SORA +2 as a benchmark itself. So to a long answer to the question itself, it is not assuming distribution. Distribution is distribution itself, which is 5 to 6% dividend yield. The target return of the fund itself on an absolute basis is actually SORA +2. Of course, we want to beat the benchmark. Yeah, so I hope that will actually help to answer the question. Can the dividends be used to reinvest? Obviously, yes, because like I said, you have an accumulation share class. Even I think on the distribution share class itself, I think you can choose to reinvest back. I'll let FSM handle with that question. Maybe while we go a little bit more, I wanted to highlight this certain point about what the AI ML can do, because I think Paul has talked about it quite a fair bit, and also talking about some of the some of our existing funds have won some awards as well. So I think like what Paul has mentioned at the start, whereby it's a lot challenging right now in terms of how the markets are going to move. There's a lot more geopolitical tensions. We do not know, unfortunately, when is the next war going to break out. We do not know when it's going to be another ban coming from, whether is it from the US, from China, or from any other countries out in the world. So it's getting more and more challenging and tough. And I think Paul has been always within internally in UOBAM and stuff, he's been saying that markets always goes about 5 to 10 years. Right now, we don't even know whether markets will move and how it will change in the next 2 years. So it's getting shorter and shorter. So with the AI/ML coming in, right, it will actually help in terms of asset allocation. That means to say that we look at a rebalance on a quarterly basis. So right now in Q4, for example, right now you're coming in during the IOP period. Going into Q1 2024 itself, the AI/ML will actually start to predict and suggest to the Paul and team to say that, okay, let's go into certain percentage into REITs if we think the REITs are going to rebound. Probably we will go into equity market. That's also one of the other areas that we are looking at as well. So that will actually help the team to understand, okay, where my allocation will be. And that is actually rebalanced on a quarterly basis. So to Paul and team is that there's a lot more flexibility and to be able to be nimble enough to move around the different asset classes. Because like what Paul mentioned, if you have last year invested into any of the global markets, you are down 20%. Basically, you are like a sitting duck. So you are not nimble enough to switch, and you do not know how to switch. So I think that's the key point that we wanted to highlight, that by buying into a multi-asset fund, with the help of the AI/ML coming in, it will help you to do the allocation in a more dynamic manner and to predict what is going to hit in terms of the next 3 months. So I think that is one of the key feature. And I think going into the next few years with a higher for longer regime, I think that is going to be very important in terms of client portfolio, because it is honestly very difficult to move around and say, I want to switch from equity to balance, I switch from balance to fixed income, and so forth. So it's going to be challenging. I'd rather you spend the time with your loved ones and whatever that you're interested in, right, then go through all this process and all that. Yeah, Paul, you want anything to add on this also?
No, nothing else to add on. I think there's some questions also on the payment from capital. Maybe you can help them with the question.
Yeah, so on this part itself, right, like we said, there's always a disclaimer. We do not aim to pay out from capital. That is honestly our aim itself, but there is always a possibility of doing so. So that is actually our last resort, that we need to pay out from capital. So on this point itself, I wanted to highlight that yes, the fund is paying on a 6 months or rather monthly basis with about 5 to 6% dividend yield. But what you're trying to achieve here is that once the fund goes IOP or goes live next week on 16 November itself, for the first 6 months itself, we do not intend to pay dividends. The question coming probably after this is why? Why do I invest now and then you're not going to pay for the next 6 months? Actually, the very simple answer to that is that we want the fund to be stabilized. We want the portfolio to stabilize. We want to see how the portfolio is going to be generating the returns coming in. And at what point I've shared, when the markets start to move, we are confident enough of collecting the dividends coming from your Singapore equity, Singapore REITs, and Asian equity. So on this point, on a side note, I wanted to bring this point about the Asian equity part as well, which is one of the 5 asset classes. Why we have the Asian equity allocation, which is up to 20%, is also, there are 2 main reasons. One, when we're talking about when the markets are moving up itself, right, we want the additional kicker, the additional booster. So the Asian equity portion can come in to help to have the additional kicker and a sweetener in terms of the overall portfolio growth. Okay, that's one. The other role that it plays is also the dividend part. So we know that the equity market and the REITs market in Singapore is attractive, like what Paul shared in terms of what are the numbers that we're looking at. But with the addition of the Asian equities capped at 20%, that will also help to boost up in terms of the dividend yield as well. So with that, that's why we are quite confident to say that, we aim to achieve about 5 to 6%, of course, depending on how the market condition pan out. But again, long answer to the question itself is that we will try and aim not to pay out from capital. If we have to, that would be the last resort. But the disclaimer is always to say that there is always a possibility. So that is, trying to explain a little bit in terms of paying out from capital itself. Yeah. In the years that you do not meet target, do you draw from capital, and so how does that work? So of course, I think this is a very good question. So what we try to achieve here is that if let's say the yield is dropping, of course, that's what we will try to highlight to our clients and then put it out early to say that we probably need to revise the yield lower to maybe about 4%. Throwing out the numbers here for discussion's sake itself. So like I said, we will always try not to pay off from capital. I think that's the key. So as a fund house itself, as our duty to our investors and all that, that is really our last resort. So if possible, we'll try to reduce the yield. We'll let you know in advance. We'll notify the unit holders. We'll let all the platforms know about, this about, hey, we're going to reduce the yield because of these reasons. So I think that is try to, help to achieve, or rather, we'll aim to answer that question that the audience actually asked about it.
Yeah, maybe I jump in a little bit here. So I think I shown in one of the slides before that the REITs are paying out something like 6 or 8%, 7.6%, right? And then the even the money market now, the short term, you are being paid 3.85%, right? And then you have you have Singapore bonds, also the 3-ish, and then you have I mentioned the STI itself is paying 4.6%, right? So only I think the Asian equities is a bit lower. I think it's probably closer to about 3%. So you can see that actually the underlying asset classes themselves are income generating, right? So so there is kind of kind of like a base there, I would say, like a base to pay out. Obviously, the capital, we need to make a bit of capital gain every year, a couple of percent more, in order to make that 6% target, which we think is actually quite a realistic target. I don't think we are over promising. So like I said, on top of the income that's been paid as dividends, we just need to do a couple more percent on top of that. On average, every year, over a reasonable period of time. Like I said, some years are positive. In some years, the market is very negative. There's nothing we can do. But actually, on average, again, looking back at the history, that should be quite a realistic target.
Yeah, thanks, Paul. Maybe I just get on. I think this question about the retail client buying the B share class income. If you do not mind, maybe we can take this offline, and maybe probably you can send in your question to FSM, and probably from there we can we can discuss offline a little bit, because we just want to understand a little bit in terms of what are your needs and all that, because the like I said, the B share class is really for our institutional clients, and we're happy to take the discussion separately on that part as well. Paul, you want to take this, which is the worst return from the back test?
Yeah, so I just changed my slide so we can see it. So actually, I touched on this. So based on this, unique combination of assets. So like I say, I think if you're all equities, only if you buy only equities fund, yes, the worst drawdown over this period, I think, would have been something like 30%, close to 35%, right? But because you also hold bonds, you hold money market, and then we switch around, actually we managed to contain the damage. And then actually you can see that based on our back test, right, the worst result so far, right, in the worst of time, the worst drawdown is only about slightly less than that. Okay, call it 10%, right, versus 30%. So I think hope that answers the question.
Yep, thanks, Paul. Maybe I take on this question, which is the fund available only on FSM? So to be honest, it's not. It's also available on other platforms as well. But I just wanted to highlight, to carry on this point, is that right now, we are into the last quarter of this year, and I think everybody is also thinking something on the back of the mind is about SRS. So your SRS investments, right? Some of the members of audience here today, probably you already have an SRS account with a bank, with an Asian bank itself, and probably you have updated your account details with FSMOne as well. So I mean, I just went through the website and all that. I realized that there's actually an ongoing SRS promo at FSMOne page itself. So basically, you can run through the information. This fund itself, which is the Singapore Dynamic Income Fund, is also available for SRS as well. So if you are keen, make use of your SRS for the investments. You can actually achieve some of the promo mechanics and all, which I think the FSMOne team will be more than happy to share. And I mean, it's the best of both worlds, right? You get something out from your from an FSMOne account. At the same time, you're also investing your SRS account into this fund itself, which is actually planning for long-term retirement planning as well. But just to last point to add on is that while we look at your equity portfolio and all that, is really to think about your MAS T-bills and all that is attractive, is great, it's been doing wonderful and all that. But we can move aside and really think ahead and say that what exactly is my financial goals? Because if you want to rely on T-bills to help you to achieve financial goals, honestly speaking, I don't think it will actually happen. And if not, then what do you need to do next? So I think that's the key point whereby you really need to have the equity exposure. And that's why we want to bring in this Singapore home buyers multi-asset fund to help you to achieve that goal in a more step-by-step manner. And then at the same time, with the multi-asset, with the AI coming in, that will actually help you to adjust as the markets are going to be a lot more challenging. So that is really some of the underlying points that I want to reiterate, to the members here today as well. Yeah. Paul, how did the strategy do in 2022?
Yeah, sorry, I was trying to look for the exact number. Just scrolling through my file, couldn't find it fast enough. But so last year when most people were double negative, right, 20% negative, I think the fund strategy did about 1%. So I can't remember 1 point something whatever. So I can't give you the exact number, but it should be around 1%. So it's positive. It's not great, but at least you're not losing money, right?
Yeah, I think that also nicely fit into the next question about how does the fund fit into the one's overall portfolio. So like I earlier shared, so imagine your portfolio right now, you have your equity and fixed income, which is always the case, right? So right now, actually, to be honest, when you T-bills at 4%, right? If you think about what is your long-term target, let's say 8 or 9% that you kind of target, your T-bills, which is at 3.5 to 3.8, is really your base, and it's guaranteed by the government. I mean, you can't run away from it. So the other gap is getting smaller. You only have about 4-ish to about 5%. You are looking at to achieve the overall blended portfolio. So what we are trying to suggest here is that we are not asking you to go against T-bills. It is still fantastic, but what I'm trying to say is that with the T-bills in your portfolio, you can add on to it. So whatever the amount that you intend to invest into the T-bills itself, right? Think about trying to split that amount. Think about trying to allocate a little bit into the equity portfolio, because this fund itself can fit into your equity portfolio. Within the equity portion, it can form the core or the core of the base of the equity portfolio. That means it will be your base, it will be your core. You know that you can sleep soundly, and because you know that Singapore centric, you are familiar with the names. And then as you gain confidence in the markets, right, as you are more familiar and investing and going back to the equity and the market start to turn, right, that's where you can go for more exciting items, and then you can go into China, tech, or whatever it is. So if you ask about how does it fit, I would say it will fit it nicely into your equity sleeve of your portfolio. Within the equity sleeve, it is your core. It can actually form the core of your equity sleeve. Yeah. Paul, you want to add on a little bit more or anything else? You want to? Yeah.
All right. Okay. Thank you, Paul, and thank you, Roger, for the wonderful sharing. And I also want to thank everyone here for all the burning questions that you guys have. And it has been a great sharing, I would say. I believe we have learned a lot about this new fund from their sharing. And also a big thank you to everyone here who spent this evening here with us. I hope you find the sharing useful in your investment journey, and I really hope that the fund can in a way be a way, as Roger shared earlier, a core part of your portfolio. In any case, I also want to thank Roger again for the plug. Yes, we are running a SRS promotion right now, and yes, we are thrilled to say that the new fund, while it's still in IOP stage, you will be available in the SRS promotion. So do click on the link in the chat box. Take note and take advantage of the SRS promotion to supercharge your SRS portfolio. So I want to add on this to say that if you're interested to subscribe to the fund is still in IOP period now until 15 November, whereby 16 November you start trading at NAV. So if you're interested to subscribe to the fund, do log on to FSM website, search for the word United SG Dynamic Income Fund, and you'll be able to find the fund fact sheet and the fund prospectus. And then we are also be putting up an article whereby we have do an exclusive Q&A with Roger and Paul about the fund itself. And in the article itself, there will also be a step to how to subscribe to the fund through the FSM platform. Just give me 1 second. Let me pull up that article, and then I'll put it in the chat box for everyone to click on it. Right. So this Q&A will also have more answers and questions to questions that you might have along the way as you find out more about the fund. So with that, I just want to say thank you again to Paul and Roger for spending the time out here to answer the questions that you guys have about the fund itself, and the webinar has ended. So have a great evening, everybody. So I'm going to leave the room open for a while. So feel free to exit the webinar, and we'll see you at the next one. Thank you once again, Paul and Roger.
Hey, thank you. Thanks, 𝗍𝗂. Thanks, everyone. Good evening.
Thank you. Bye.
Yeah. Thanks, Paul. Thanks, everyone. Cheers. Bye.